What was actually, priced in? It seems that the markets largely ignored any kind of political risk so far. This would point to the fact that maybe they were right to, but why aren't they pricing in political risk, geopolitical risk?
Because I think there's a lot of fatigue around it. So we've gone through a whole heap of political events over the last few years, be it Brexit, be it the French presidential election, or be it the sort of uncertain Italian election that's come out over the weekend. And the markets initially in those early years were sort of pricing for a negative outcome, and then the markets just rallied away again. So people have kind of decided not to really worry too much about the downside until it actually hits. So I think that's kind of the sort of sentiment in the market at the moment.
You agree with that, Larry, or is it algorithms? Or it's just because you don't know really how to price the threat of a possible nuclear war?
Yeah, I think over the medium term, there's a lot of validity in what was just said. You should add to it that the backdrop was very positive, improving global growth, strong corporate profitability, and that allowed investors to essentially bank on the fundamentals, even if they had some concerns about the political backdrop. As those fundamentals now begin to shift, not so much growth or earnings per se, but we obviously have much higher, let's say, hurdles to overcome here, multiples of that much higher, markets have advanced and so forth. So the ability of those positive developments to support markets is not as strong, and suddenly we have the arrival of certain forms of new risk. I mentioned protectionism before. That's why I think markets are struggling a little bit more now.
Yeah, and we'll talk about tariffs and protectionism in just a second. But yesterday I had a great conversation actually with Daniel Pinto, co-president of JP Morgan, and he was saying that the markets could correct 40%, 40% in the next 2 to 3 years. Is that a view that you share?
I would say that's very much in the tail risk scenario for me, not rather than sort of a central scenario. It's possible. What you'd have to see, I think, in that environment is a genuine threat to global growth, hence to global earnings, which would obviously lead to multiple compression. And that's how you could add up to that type of a correction. But those things are not actually that apparent at the moment.
John?
Yeah, I'd say amongst our client base, the amount of cash that clients are holding is very high. So I think a lot of people are waiting for a pullback, maybe not 40%. So I think they would step in ahead of that. I think one of the risks that could potentially lead to some problems for the markets is if inflation does start running materially hotter. So if we do see yields move up materially, and we're talking sort of 10-year yields in the US sort of above 4 for that kind of a scenario, then I think risk assets in general will struggle. But even then, it's hard to get down to 40%, but a setback would definitely be possible.